Hello and welcome to Asia Gaming Brief's face-to-face series. Today I'm talking with Colin Mansfield, who's an analyst at Fitch Ratings. We're going to be talking about the Macau operators and why Fitch recently put them on Ratings Watch Negative. Colin, thank you very much for joining us today. We last spoke around a year ago now, and I'd like to ask you first of all, whether the year has panned out like you thought it would.
So I think that it's a little bit worse than we were anticipating, mainly on the visitation front. It's been a lot more depressed for a lot longer than we thought this year. And also, like a lot of the investment community, I think we're optimistic that once the vaccinations really started rolling out, that you'd start to get more of a snapback in demand and visitation and things would go back to normal. While that's true here in the US and some other gaming markets, that really hasn't been the case over in a lot of APAC jurisdictions. So I think that's where, we had to look to revise our forecasts for both 2021 and 2022 as the lingering travel restrictions and really tight health code policies weighed on visitation a lot more and a lot longer than I think we had originally anticipated.
So when are you foreseeing now full recovery, if you are foreseeing that?
So full recovery on the mass side, we're modeling for 2024. The market as a whole probably will take a little bit longer than that because of some of the challenges in the VIP sector right now. 2022, we think is going to be another volatile year. Regardless of what vaccination rates are, I think it's inevitable that we are going to get, COVID cases every now and then, and the tight policies that both Hong Kong, Macau, and the mainland government have inevitably are going to cause some volatility for shutdowns and travel restrictions, unfortunately. So we don't see a lot of change for 2022. We really think it's going to be another couple of years before you start to see more meaningful improvement in visitation.
Wow. How concerned are you about the Omicron variant?
It's definitely a concern. I think it adds a degree of uncertainty around how we feel about our 2022 forecast, much like other folks in the investment community. It's hard to have a high degree of confidence until we know if Omicron is going to be a variant that has less severity or it's less transmissible. I think if we get more information on that, we'll get a little bit more comfortable with how we're seeing 2022 play out. But inevitably, viral variants are a risk that we have to incorporate into our forecast, and definitely has us skew a little bit more conservative as we think about recovery in gaming revenues or visitation.
So, given this potential for another year of extremely low revenue base, and at a time when the operators have pretty much cut everything back down to the bone, are you seeing any cracks?
Not yet. The good thing about the Macau operators and some of the global gaming operators in general that are related to these companies is that they have a lot of excess liquidity. So it's allowed us the patience and the time to look through some of the more challenging years like 2020 and 2021 and now 2022 because they have enough liquidity to ride out the storm. And it's allowed us to be a little bit more patient as we think about the credit profiles that should begin to normalize more in earnest in 2023 should our assumptions for visitation and gaming revenue come to fruition.
In a worst case scenario, how many years of this kind of low visitation do you think that they could sort of bear before the strain was there?
Well, 2022 is going to be a pivotal year because we're starting to enter the third year basically of the pandemic. And that's part of the reason why we placed the entire sector and the operators on Rating Watch Negative last week. It was two-pronged: one, the regulatory uncertainty, but also the recovery uncertainty. Because as we're getting into the third year, if we're not really seeing a recovery in visitation start to materialize or crystallize, it really begs the question of what does the long-term visitation trajectory look like for Macau? And while it's still positive, I think credit risk will increase if visitation next year really doesn't start to improve materially, because then you start to get to a point where you have to question what is the normal amount of cash flows that these companies can generate relative to the amount of debt that they have. So, there's a possibility that if that recovery doesn't start to materialize, credit risk will increase if there's not a commensurate amount of debt pay down, given a structurally different cash flow profile.
You just mentioned regulatory risk there as being one of the reasons for those downgrades last week. or not downgrades, putting them on credit watch negative. How big a factor is that for you? I mean, you said sort of imminent and rising, I think were the words that we used.
Yeah, so we're entering the 6-month mark before the concessions expire. And while the government and the regulators are working towards the rebidding process and what that structure is going to look like, there's definitely increased uncertainty around what that's going to actually look like. How does that impact cash flows and balance sheets, and who ultimately gets the licenses? Well, we're still believers that all of the operators will remain in Macau operating long term, and we think the loss of concession is a relatively low risk. It's one that can't be ignored, and something that we wanted to communicate to the marketplace, that there is potential for downside credit risk here, because we're not exactly sure how this is going to be structured. Now, there has been some communication around possibly when those details will be coming out, which is a positive. But at this point, we think there's more credit downside risk than upside risk, until we get more clarity on what the next concession structure is going to look like and how that's ultimately going to impact the cash flows and the balance sheets of the operators.
Are you concerned that they may be required to invest in more non-gaming on considerations that are not purely economic and financial, rather than to sort of fulfill a vision?
I mean, at this point, any sort of capital commitment, I think, is something that we're building into our base case when we think about what it could potentially look like. That's in line with what the regulators and the governments in the area's broader goals are, and all of the operators have done a very good job supporting those goals through the current concession term. So I don't think it would be too surprising that to us if there were capital commitments related to other developments that help support those broader goals, but we would think there would be a commensurate return profile that the operators would demand to be able to commit to spending those type of dollars.
Okay, so in the best case scenario, we are going to have regulatory clarity next year. COVID isn't going to be as big of a problem as we thought. Who do you think is best placed for a recovery?
Probably Las Vegas Sands. They're more geared toward the mass market already. They have the most hotel rooms, so I think that's probably the operator that we would think would be best positioned to take part in the recovery, as evidenced too already by some of the shorter periods when in 2021 when there haven't been a lot of travel restrictions. It's evident in the numbers. One company I think I'd call out that would be a little bit more concerned with is Wynn Macau, just because of their historically higher mix of VIP. But in any case, as long as the mass market's recovering in Macau, all operators are going to be seeing a commensurate recovery. But we think Las Vegas Sands is probably going to be geared towards, geared towards the mass market the most and would benefit probably the most.
And what about the Grand Lisboa Palace? Obviously, it's launched in the worst of possible times. Given the operating environment, how have you seen that ramp up?
So it is a little bit of an unfair time to be judging the ramp up of the property. I think it goes back to the fact that the whole market is not performing well right now. But what we still hold is that that property is going to ramp up over a period of years and not necessarily months. So there's a long runway to go. In our forecast, we have it basically maturing by about 2024 and generating cash flows of about 450 million US dollars with margins in about the mid 20% range. So the property will work. The problem is it's going to take a little bit more time to ramp up. So it is a little bit of an unfair environment right now to judge how it's been performing. I look forward to seeing it in person when someday and being able to comp it to some of the other properties on Cotai. But at the end of the day, more hotel rooms is a good thing for Macau. So it's a positive for the market. It's a positive for Cotai.
I was slightly looking at some of the mix, given the loss of the VIP. Obviously, there's going to be quite a few VIP tables that are going to be freed up now that can be dedicated to the higher margin mass market. How will that help?
Strictly speaking, if you're moving tables from VIP to mass market, you're going to immediately get a margin benefit because the margins are better, and that's good for cash flows for the operators. It's also good just from a stability perspective because the mass market business historically has been less volatile than the VIP business because the VIP business is driven by some other factors as opposed to just rising middle class and further penetration of visitation into mainland China. But I think first and foremost, you might see a little bit more of a revenue impact. But the good thing is that you'll make up for that on the cash flow side because the margins are better on the mass market side.
What about outside of Macau? Have you got any thoughts on how the recovery might proceed in the rest of Asia?
So I think it's going to remain challenged relative to the United States and even European markets where it's a little bit more digital focused. We do see a lot of the APAC jurisdictions lagging that of their Western peers, mainly because of the strict health codes and the travel friction that continues to persist as we get into 2022. I think that's been a benefit for markets like the United States and Las Vegas specifically, where when you remove the travel friction and there's a little bit more of a living with COVID mentality, the leisure demand has been really strong and you get a snapback in performance. And unfortunately, I think what's going on in a lot of the APAC markets is that the very strict health codes and disruptions from when there's localized cases and you shut things down and limit the movability of people, that's really going to make those markets lag in recovery relative to some of the Western ones, I think, in 2022.
Thank you for joining us today. I've been talking with Colin Mansfield, who's an analyst at Fitch Ratings. Please join us every Friday for Asia Gaming Briefs interviews with thought leaders in the Asian gaming industry.